Welcome to another in a series of NJAPM webinars. Today we're going to talk with Michael Lehner. Michael is a principal in the Bridgewater office of ZBT, Certified Public Accounting and Consulting. He has extensive experience in complex litigation matters, including calculating damages, performing forensic investigations, and providing business valuations for clients in various industries, commercial litigation, gift and estate planning, mergers and acquisitions, shareholder buyouts and buy-in transactions, and matrimonial matters. Michael works with divorcing spouses by valuing businesses for equitable distribution and determining true income for support purposes. So welcome, Michael.
Good afternoon. How are you?
So let's start with, I'm a mediator, obviously, and most people watching this webinar today are mediators. So how do you get involved in the mediation process? I mean, are you typically called in by the clients, by the mediator, or by attorneys?
Most of the time, I am brought in by either the mediator to help them in a matter where they realize that a business valuation is necessary to help them move forward with the mediation, or I'm brought in by the attorneys who bring me in to help them prepare a valuation for a matter that is in mediation. So it's either or, it's both.
Okay.
Very rarely is it just the client.
Right. And in most cases, are your clients represented by attorneys?
Most of the time, yes.
Okay. And do you do both civil and divorce valuations?
Yes, I prepare valuations for both matrimonial matters and commercial matters. Most of the time when it is in mediation, most of the time it is a matrimonial matter.
Okay. And what percentage of your business is matrimonial versus civil?
In mediation, probably around 80% matrimonial. Overall, matrimonial is probably a little bit less than half of my entire business valuation business.
Okay. So when you come into a mediation, do you sign an agreement to mediate as one of the parties to it, or do you have your own agreement?
When I'm engaged by the client, my engagement letter is that I am going to be hired by them to perform a certain service, in this case, a business valuation, and that valuation is to be used in mediation.
Okay. And I assume it has a confidentiality provision in it?
There's actually not a confidentiality provision in it. As a CPA, I follow the rules of the AICPA for confidentiality, which means essentially that I cannot provide any information to third parties without the client's consent.
And if for some reason the mediation broke down and one party wanted to take you to testify as an expert witness in a court proceeding, would you do that?
Generally speaking, since in a mediation I'm hired by both parties, I would need to be hired by both parties to move forward in the matter.
Okay. So let's say that the mediator has clients and they have a business, and it could range from very small, and there's a question of whether a valuation is even, worthwhile, right, to one that it's pretty clear that, you're talking about a substantial business and the mediator is urging the parties to get it valued. So let's focus first on the first one. It's really small, but the parties say, one party at least once says, oh, it has some value, I want to get some value out of it. Could the mediator urge the parties to call you to just get some sort of rough frame of reference as to whether it's worthwhile doing?
Yes, of course they can call me and we can discuss whether or not a valuation is needed. But oftentimes, if the valuation is of a very tiny company, it may not be worth performing a valuation. We will discuss what the pricing of a valuation would be and whether or not the client thinks it's worthwhile to have the company valued based on what they believe the value of the company might be.
Okay, so starting at the low level, they call you and they say, and you say, no, that's not worth Does that cost them anything?
No, if it's a short phone call, no.
Okay, but now it's in the range of like $300,000, $400,000 of revenue, and clearly it should be valued. What are the price ranges for what your services might run?
Generally speaking, a company such as you're mentioning, I find that the price range to just prepare schedules, which I can then use in the mediation and avoid writing reports if necessary. I can prepare those schedules in the $4,000 to $6,000, $5,000 to $7,000 range.
Okay, so what's the difference between schedules and a report?
Basically, if I was to write a full report, which would explain everything that I went through to prepare the valuation, which would go through items such as the company doesn't need, such as the industry, the economy, and the background of the company and the valuation approaches. I'm not going to write that report. I'm going to give an oral presentation of the schedules, which would have been attached to that report.
Mm-hmm.
That's going to save the client a lot of money because they don't need me to write that report in the matter. And that's what I'm going to do for around, again, $4,000 to $6,000 to $5,000 to $7,000.
And if you did the full report, how much would that be?
Could be 12, could be 15, 9. It really depends on how much is involved.
Okay. If you had to go to court, you'd need the report.
If I went to court, I would have to have a report written. Yes. That's why in my engagement letters in a mediation engagement, it says that I'm preparing schedules for mediation purposes. And if we're going to court, I would then have to prepare the full report.
Okay. So the mediators urge the parties to get their business valued. They have listened to the mediator. They have now come and met with you. Describe what you're going to tell them.
I'm going to walk them through the valuation process of what we're going to do. I'm going to talk to them about the different approaches I'm going to use, whether it's going to be an income approach, the market approach, and the asset approach, and why I would use those approaches. I would talk to them about what I like to do with them is to agree on certain assumptions in the matter so that maybe we can avoid the costs of doing forensic accounting, but we can do forensic accounting if necessary. But if they can agree on many of the assumptions, that will save them a lot of money. And I'm going to talk to them about what I'm going to do is take the assumptions that we can agree upon and use those assumptions in my evaluation to prepare the schedules that I'll then meet with them so that I can give them the valuation that they need to then take back to the mediator and help settle the matter.
So describe the main valuation methods.
Well, very often what I'm going to be doing is I'm going to look at the asset approach, the market approach, and the income approach. Oftentimes, the asset approach is going to be used just for holding companies and companies that are losing money, companies that are worth more dead than alive. So I'm very often not going to be using that approach. More often, I might be using, say, a transaction approach where we will be looking at the publicly traded companies that might be appropriate for the closely held company. But as you know, if we're talking about small, closely held companies, publicly traded companies are also probably much too large. So most often when I'm using a transaction approach, I'm going to be looking at reported transactions in the marketplace. And there are a number of databases out there where I can find transactions in the marketplace, whether it's PratStats or BizComps that some of you may have heard of, where I can find transactions in the marketplace. And what I like to find is at least 3 transactions of similar comparable companies to the subject company. If I can find 8 companies or 30 transactions, that's even better. What I'll tell people very often is one transaction doesn't make a market. So many times people will come back to me and say that, you know, I know of this company that's sold, but we only had that one company, then that's not going to make a market. But I'm going to look at the transactions in the marketplace. We're going to look at whether we could look at derive multiples from those transactions, whether it's a price to earnings multiple, a price to revenues multiple, a price to EBITDA multiple, whether or not those multiples are going to be appropriate for valuing this business. I'm going to find maybe 20% of the time of the valuations I prepare, I am going to be able to use that transaction approach. Most of the time, what I'm going to be doing is an income approach, where I'm going to take the historical earnings of the business. As you know, many times the business valuation experts will ask for the past 5 years of tax returns and financial statements. What's important there is we're not valuing the past, we're valuing the future. So it's not just taking an average of those 5 years. We're going to take those financial statements or tax returns and use the past as a proxy for the future. So we're going to take that information, we're going to look at trends, we're going to try and find things that we may need to adjust to determine what the future is. Because when we adjust the future, that's what the valuation is going to be based on. Because when somebody buys a business, they're not looking to buy a business based on the past. They're looking to buy the business based on the future. So the fact that the company made, $20,000 last year and it's going to make $1 million next year, well, let's determine why, if that makes sense. Because we're going to value the company based on how it's going to do in the future. We're going to look at things in the future and make adjustments for it. So if a company in the past had, say, an extraordinary or non-recurring item such as a flood loss, or maybe it was a printing company that was making billboards for a candidate who lost, so they'll never have that assignment again, and that's extraordinary income, they'll never have it again, we're going to adjust for that. We're going to adjust for things such as non-business expenses. If the client is running personal autos, personal cell phones, vacations, non-employees through the business, we're going to adjust for that. We're trying to figure out how much money is really going into the owner's pocket. We're going to look at things such as reasonable rent, because if many times we know that an owner in a company also owns the building, many times for tax purposes, they're not going to charge the right amount of rent. They're probably going to overstate the rent to save on taxes, save on employment taxes or FICA wages instead of taking it through payroll, and they're going to overcharge rent. We're going to make an adjustment for normalized rent. These are just many adjustments, including officers' compensation. We're going to look at what is reasonable comp, adjust for that. Maybe the company has, and basically when I'm talking to a client, I usually have had the information in advance, and I can then parse out which one of these adjustments might be more appropriate. You might have a situation where you have maybe the client purchased in the last year $100,000 worth of equipment and depreciated all in that given year, where we know that the useful life of that equipment is going to be over the next 10 years. We'll adjust for that so that we can match the earnings with the revenue. Or again, what we're trying to do is figure out what is the normalized income of the business. And we're then going to use that normalized income, because that's really the money that's going to go into the owner's pocket. And we're going to use that in most likely a income approach, whether it's a capitalization or earnings approach or a DCF. Should I go into those two methods?
Mm-hmm.
Okay, so a discounted cash flow method, or DCF, is essentially a method that we use when a company is expected to grow at a varied rate over time, and the company has projections. What I often find many times, again, I would know this if I knew your client, I would know this in advance. If the client has projections, we'd have to test to determine whether or not those projections are reasonable. What I find most of the time with small, closely held companies is that they either don't have projections or that those projections are not reliable. So most of the time we're going to use what is called a capitalization of earnings approach, where we take, like I mentioned before, those 5 years of historical earnings, and we're going to make the adjustments to determine what the future is, so that that's the amount of money that we can expect to go into the hypothetical owner's pocket, and we'll be able to use that to determine the value.
Okay. So before we go on, I just want to tell everyone who is not familiar with using Zoom, if you put your mouse down at the bottom of the Zoom screen, you'll see a function called Q&A. So you can use that. And if you want to ask a question, we will be addressing those either as we go along or at the end. So are you describing all of that to the clients?
Usually, I won't go as in depth as I just did there, because I will have usually received the prior at least 1 year's tax return or financial statement, and I can parse down the adjustments and the the tasks that I see that I may have to get involved in, so that I can just focus on what the client's going to need. But because it's a broad audience, I gave more of a wider range of things that we might be talking about.
Okay, so I've heard the terms fair value, fair market value. What are the difference between those?
Well, fair value is the most widely stated valuation method that is used, and fair market value is. There are many different standards of value. There's investment value, or an intrinsic value, fair value, book value. But most of the time in matters, we're going to use what is the most widely cited value, which is fair market value, which is as per Revenue Ruling 5960. And it was originally put together 60 years ago for estate and gift tax calculations, but it's routinely referenced in the valuation of most closely held businesses for litigation purposes. And Revenue 5960 basically said, or does say, is that fair market value is the price at which the property would change hands between a hypothetical willing buyer and willing seller, neither being under any compulsion to buy or sell, and both having a reasonable knowledge of the relevant facts. And that's a definition that most business valuation experts will generally rely upon. It's important to note that the buyers are hypothetical and not specific, and both have reasonable knowledge of relevant facts. And when you bring in a specific buyer into the equation, whether it's going to be called, instead of fair market value, it's going to be investment value or synergistic value. And the difference between investment value and fair market value is, for instance, I said fair market value is a hypothetical buyer. In synergistic value, you might have a situation where you have say a small company, factory, and it has excess capacity, and it buys another factory down the street, where the idea here is that we're going to absorb all the revenue of that acquired company, but we're not going to have to absorb all of their costs because we have excess capacity. That's going to arrive at a more profitable company, in theory. That's why it's synergistic value, but that is not what fair value is, fair market value is. And that's where you get many times when I'm talking to clients and they tell me about what they heard that, friends who are in the industry sold their business for. What they are often referring to is actually synergistic value and not fair market value.
Okay,
now,
so what's the difference between fair market value and fair value?
Well, fair market value is, again, the definition that I gave. Fair value is actually the amount that will compensate an owner who's involuntarily deprived of the asset. Commonly, there's a willing buyer but not a willing seller, and many consider it to be fair market value without discounts. However, in the state of New Jersey, two major cases are the Balsamides and Wheaton, the Lawson Martin Wheaton cases. They were both settled, ruled on actually on the same day back in 1999, one with and one without discounts. And it's because of the facts and circumstances within the cases. So generally speaking, fair value, whether it's in a matrimonial matter or an oppressed shareholder case, is going to be without discounts. That's not entirely the case. If anybody's interested in getting the sightings for this case, they can call me or shoot me an email, and I'll give them the sighting for both the Balsamides and the Wheaton case. But they're different. Again, they were ruled the same day, one with and one without discounts.
Okay, so explain discounts.
Okay, many times in a business valuation, what we're going to be doing is, and again, this comes into when we first get involved, we're going to determine whether we are valuing either 100% owner or some other controlling interest, or a 49% owner, or a 1/3 owner, 1% owner, or some other minority interest. And once we know what that ownership percentage we're going to be buying, we'll know whether or not we're valuing a controlling interest or a minority interest. When we're valuing, and once that's decided, we then get to determine what cash flow stream we're going to be using. Again, I was talking to you before about adjusting the cash flow stream, making those adjustments. So we're going to adjust the cash flow stream as a controlling owner would, or we can't adjust the cash flow stream because a non-controlling owner cannot adjust the cash flow stream. So the discounts that are very often applied would be, if I'm valuing a small, closely held company and I'm valuing the company of a controlling owner, there's not going to be a discount for lack of control. He has control. But if you're a 1% owner in that company, you're not going to be able to, you're not going to have control of the things such as compensation, distributions, contracts you're going to have. And you're going to then want to, we're then going to apply what is called a discount of lack of control to that valuation. Generally speaking, that discount's going to be in the range of 10 to 20%, but that's as a general rule. The other discount that we also many times get involved in is the discount for marketability. But a discount for marketability, again, only applies to our small, closely held companies. And the best way to describe it is if your client owns shares of Apple stock, he's going to be able to just log on to his account, sell his Apple stock, and get that money immediately or next day into his account. But when he owns a small, closely held company, the company needs to be marketed for sale, and he's not going to be able to get that money right away. And for that, in fact, he may not be able to sell the company at all. And that's why there's going to be a discount for marketability. It's because the company is not as marketable when it's compared to what are marketable companies, like I gave you the Apple stock scenario.
Okay, so you've now sat down with the clients.
Yes.
You've described what you've done or you're going to do. Okay. They retain you. They say, yes, we want you to go off and do this. They've agreed on price. How long does it typically take you to do, to get your schedules?
I usually tell people I need 30 days from when I get all the information. Many times I can do it quicker, but I generally tell people 30 days.
Okay. And so you're finished. You're finished your schedules. Mm-hmm. Do you call then the parties and they come in and meet with you?
Generally, yes.
And the mediator is not involved?
I keep the mediator up to date at all times on what's happening in the case.
Okay. But you don't sit down with the parties and the mediator, you're sitting down with the clients.
It's more rare that I'm sitting down with the parties and the mediator. It's more where the mediator brings me into the matter so that they can get the valuation done, because they know that they cannot help mediate the rest of the matter until the valuation of the business is performed.
Okay. So you're now probably come up with 3 valuations. Maybe the asset value, I don't know if you present it and say, well, this is not appropriate to use, or maybe you don't even do it. But you have at least 2 others, right?
Right. What I do is I tell the client that I have considered the 3 approaches, and that based on my analysis, this is the approach that I believe is the one that is most appropriate in your matter, and this is the value that I have arrived at. I try and give a value and not necessarily a range, because if I give a range, one party's going to hear the high side and the other party's going to hear the low side. So I try to say, I try to do that work first, and I'll say this company is worth $387,000, and this is how I got it.
According to whatever
my analysis.
Okay. Let's put asset aside for a moment. You have 2 others. And is it usual that yours is the highest one of the 2, or could be the lower of the 2, or how does it break?
It could be the highest, it could be lower. They should be near each other. If I can't get the values near each other, if I come up with a $1 million value and a $200,000 value using 2 different approaches, then that tells me that one of those 2 approaches is not appropriate in that matter. So that should be thrown out, and I'll determine which one, and I'll be able to explain why. Or I should be able to make the appropriate adjustments to get the 2 values close enough so that I can then feel confident that the value that I have has been, validated by the 2 different approaches that I use, and I am therefore going to choose one number over the other, and I have a reason for it.
So let's say it's around $1 million. One's around $1 million. What would you expect the other one to be?
Within 10 to 20%.
10 to 20%.
Yeah.
So let's say it's $1 million and the other is 800,000.
Right.
Now, I would think that if I'm the one who has the business, that I'm arguing obviously for the 800,000. The other spouse is arguing for the $1 million. So do you opine as to which is the better one?
Yes.
Or you do? Okay.
Yes,
Now,
I do. I will show the three approaches I use, and I will give my stated reasons in a case specific manner on why I believe that in this matter, that this valuation approach or method takes into account, let's say, the earnings attributes of the business. It might be as simple as I did an income approach. We did a very detailed income approach, made all these adjustments, came up with this value, and I only have 3 transactions in the marketplace, and they really don't give me that much information. So I feel a lot more confident in the valuation that I performed using the income approach in this matter than I do in the market approach. So I've already made that decision going into the meeting, why I believe that one valuation approach or method is more appropriate than the other. Or I might have to weight them. And many times I might do an 80-20 weighting or something like that. But I've made that determination going in. I don't believe that I should be leaving people in a range, because then if I leave the range, one side's gonna go high and the other side's gonna go low. And I don't think I've helped the parties by doing that.
how often do you get arguments, strong arguments, from one party or the other about your recommendation?
It's almost the joke that valuation experts have is if both sides are unhappy, then you did a good job. So you don't know. Sometimes one side, sometimes you hear it from both sides. Again, both sides are happy. You got the right value. Sometimes I always tell people, especially in the setting where you have, say, the more outspoken spouse, that if the other person doesn't want to speak at that meeting, that they can call me after the fact, and I will make sure that I have taken care of all their concerns.
Okay, so let's say that they have now come to an agreement. Well, let me back step one. How about if they're not happy, they're not sure?
Okay.
How often do people get a second opinion?
It happens rarely, and sometimes I'm brought in for the same purpose. I've been brought in sometimes when both parties actually brought in an expert, and I'll then help to reconcile those two experts together. Mm-hmm. Because what often happens is that the two sides are, the two sides are hearing different stories from their clients. And that's what I find often the case, is that many times it's not just whether one expert decided to go one way or another. It's actually that the story that they're being presented by their client is different. It may have to delve a little bit more into the true story there.
So it might be in that situation, the assumptions that the expert used for one party versus the assumptions for the other party are different.
Yes, and I've been involved in, again, when I'm involved in the mediation and I'm speaking to both, say, spouses, say it's a matrimonial matter, I'm going to try to get the parties to agree on as many of the assumptions as possible. And I always find that helps, because if they can agree on the assumptions, then this is the value based on those assumptions. I have at times been in situations where they cannot agree on the assumptions. And unfortunately, what happens then is I then have to prepare a valuation based on both sets of assumptions. So they can then make a determination, you know what, in the end, based on one set of assumptions, the company is worth $600,000, and the other set of assumptions, it's worth $500,000. But since that's a $100,000 split, and we're only giving one spouse a certain percentage, in the end, maybe, hopefully, the difference isn't that great. But I can do the valuation both on both assumptions. But what I'd rather do when I'm meeting with the parties is to try to get them to agree on the assumptions that we're going to use.
And give me a few examples of what kind of assumptions you're talking about.
Well, many times I'm in a situation where I'm with the business owner, but say the non-money spouse is also the bookkeeper. And I've been in the situation where the bookkeeper will say that we don't have to go through a forensic accounting and go through all the bank statements and cancel checks and credit cards. There's around $80,000 of business expenses a year made up of personal cars, non-employees that are on the payroll, vacations, and hopefully the other spouse says, might be a little high, but sounds about right. Let's use that. So that would be an assumption that we can use. Or we could be in a situation where the business owner also owns the property, and that the rent being charged each year is $75,000 a year. but they both agree that the fair market rent should really be, say, $40,000 a year. They can agree on that. We don't have to get a real estate appraiser to come in to determine what the fair market rent is. So I'm trying to do is to get people to agree on the assumptions without having unnecessary costs. If we need to get into that, we can. But generally what I find when they go into mediation, the idea is to save money. And if I can get them to agree on things without the forensic analysis, then we can, I think, save the clients a lot of money.
Okay. We have one question, which I will ask now.
Okay.
Okay. It says, back to small company where his services might not be reasonable. Is there any guidance that you can provide for quick valuation by a mediator? For example, assets minus liabilities.
That's book value, and I do not recommend book value as a valuation approach because book value does not take into account intangible assets such as copyrights, trademarks, workforce in place. It also does not take into account the fact that the business might own a building that's on the balance sheet at $100,000 because that's when they paid for the building in 1963, and now the building's worth $2 million. So that's book value. I don't recommend it. And if you think of your law practices or your mediation practices or any other service business, by using book value, your businesses would be worth basically the desk and the computers and the accounts receivable and the cash. And we all know that what's really driving the value of the business is the earnings of the business, the intangibles, the goodwill. And I'm not a fan of using book value or or shareholders' equity as a valuation, a quick and dirty valuation approach. I think of many times may understate the value of the business.
Right. You know, for many years I was an attorney, 22 years, and I was CEO of a couple of companies. And so I understand business pretty well. On the other hand, I like not knowing a lot about things because I find out if I know too much, it can get me in trouble because I never know as much as the expert. And so I've always viewed my role as the mediator as getting the right people rather than making any kind of calls at all and trying to do quick and dirty. But that's my philosophy about it. Let's take another question. Let's see. Personal service business is the most difficult, such as CPA, lawyer, consultant, commission-based salespeople. How far back for average income? 5 to 7 years?
Again, what I mentioned before is what I'm really looking at is what is the business going to do in the future? I don't want to just take an average. I want to adjust what the income stream is going to be going into the future. I'm also wary, and I'll use the CPA firm example, of just using rule of thumb multiples. Because what you'll find many times, say in the CPA practice, is that the tax practices sell for 75 cents on a dollar, and an audit practice sells for 150% of revenues. What's the rule of thumb? One times revenue? Well, that doesn't make sense because if you're buying a tax practice, you're overpaying, and you're buying an audit practice, you're underpaying. So you really want to do a thorough analysis of that specific company, analyzing what the earnings, what the makeup of the earnings are, what people are paying for that type of business, and adjusting for what that business is going to be doing in the future, determine what the value of that business is.
Okay, I've heard the terms conclusion of value and a calculation of value. What are those?
Well, a calculation of value is nothing more than an agreed upon approach by the appraiser and the client as to the manner in which the client, as to which the business valuation expert will be done. They're going to decide in advance whether or not what approaches we might use. It's really being penny smart and pound foolish. When you're hiring a valuation expert to do a conclusion of value or a full valuation report, or they're going to use their full knowledge and experience to determine what are the appropriate methods and approaches to be used in that valuation, where in the calculation of value, they're really shortchanging that. And I would not want to walk into any matter where somebody might want to contest the approach. So if I'm in a matrimonial matter or a shareholder dispute, and I value that company using the agreed upon approaches and methods by the client, I don't think that value would stand up. I would much rather be able to say that I as a business valuation expert looked at all possible approaches and all methods, and this is what my professional experience says is the appropriate way to value the company, and this is what I arrived at. I was actually in a case several years ago where I did a full report, and the other side did the calculation of value, and the judge did throw out the other side's report. And I think that, again, this demonstrates the importance of not being penny wise and pound foolish. Let's get the full report with the full analysis, and let's not just say let's only use in one approach and try and get to a quick value.
Okay. Another question: what's included in the schedules you prepare?
The schedules I prepare are basically going to be the same schedules that I would be preparing in any valuation report. They're going to show the historical balance sheet. They're going to show the historical earnings of the business. They're then going to show the analysis of that historical information, whether it's gross profit margin or a certain expenses over to revenue, so that I could show the analysis that I did of that company. I'm then going to have schedules showing the adjustments that I made to earnings, because as I discussed before, we may have made adjustments for personal expenses or related party rent. So I'm going to show this is how we started off with the reported earnings, and then this is how we made the adjustments. Now I came out with what I call my normalized earnings. And with those normalized earnings, I'm then going to show schedules with the transactions that I found in the marketplace. I'm going to show in those exhibits whether I use a price to revenue multiple or a price to EBITDA multiple. And I'm going to show how I apply those multiples to from the public information to our specific company. I'm also going to then be able to do the same thing with the income approach. I'm going to show this is the earnings that we adjusted to. These are my normalized earnings. And this is how I took these earnings and I was able to determine, say, the capitalization of earnings method. I could also show this is how I determined an asset approach. I'll show how I did each method, and then I'll have a summary schedule where I'll show this is the value that I came up with using each approach, and I'll be able to tell the client this is why I chose a specific approach or a specific method. But you're going to get all the schedules that are in my report. It's just that I'm going to orally take you through why I chose each one, and you don't have to have the written report to get there.
Typically, how big a package of materials is that?
10 pages, 7 to 10 pages.
Okay.
Not very large. The idea is to get away from the 50 to 70 page or 100-page report.
Right. It's the
exhibits. Because that's what they really need.
So the mediators met with the clients at the beginning, may have recommended that they go to get a valuation. The clients meet with you. Typically, they don't meet, you typically don't meet with the mediator. Is that correct?
Many times when I'm brought in by the mediator, they'll discuss what their concerns are, why they need a business valuation. Mm-hmm. And I will at that point meet with the client, and I will keep the mediator informed of the progress. And I will also inform them of the results when I met with the client. But generally speaking, I'm helping the mediator get the valuation in place so that they can then finish the rest of the case, because what they needed was a valuation to help them mediate the rest of the case.
So as an expert,
yes,
what's your selling proposition? Why should a mediator say, you know what, Michael Lehner is the guy to go to?
Okay. Well, what I like to say is that as a forensic accountant specializing in business valuation, I can help people in various ways. One of the best ways I can help people is just prepare the schedules to help them settle the matter in mediation and avoiding, the cost of reports and testify if necessary. I'm going to help them. We're just going to do the schedules and help them settle the matter. And I can help them arrive at fair market value or fair value. And I'm going to do it in a cost efficient and timely manner. I can help them determine whether there's any diversion of cash receipts by the owner, whether there's unreported income by the owner. I can help them if there's disproportionate compensation, but I'm going to try and do it in a way that's going to be cost effective and timely so that they can settle the case and be happy and move on with their life. One of my favorite things is to help people settle cases.
Do you think you're different than other experts in the sense of focusing on keeping expenses low for clients?
Well, there are some other firms that that try to write the full report, and I don't think many times that is necessary in your small, closely held businesses. They can settle the matters very often with just the exhibits.
Okay. Let me call for any more questions. And while we're doing that, Michael, what else do you think we ought to know? We as mediators ought to know.
Well, first thing I'll mention, I'm not sure if this is the right time, is if you have like more thorough evaluation questions, I have on my website many evaluation articles that I've prepared, put up there, and I'm hoping that you're seeing them right now, which is if you go to the zbtcpa.com website under...
It's up, Michael.
Excuse me?
I can see it.
You can see it. Hopefully everybody else can see it. If you go to the zbtcpa.com website on the slide Viewpoint on Value, you'll be able to see about 50 to 70 articles that I have on specific valuation issues, many times that are for divorce or shareholder dispute and other issues. I also have some very short valuation videos that are 2 to 3 minutes long on specific topics. And I'm hoping that those issues can help answer your more specific questions. So again, they're on the zbtcpa.com website under Viewpoint on Value. So that's one thing that I like to share, because I think many times, especially the videos that I have up there are really of questions that people ask me all the time. And that's why I made those videos, because I get certain questions asked to me a lot, such as what is fair market value, or do you need to have an expertise in certain industry, or how do you get your valuation credentials? So I've put together some, again, 2 to 3 minute videos that are up on the website that can help you see my response to those questions. Of course, anybody can feel free to give me a call or shoot me an email. I'd love to go more in depth with you on any of those questions that you might have.
Okay, another question. Explain what the wife should say when the husband says, my accountant can value the business.
There are business valuation experts that have been trained in the skill of valuing businesses. I was a traditional accountant years ago. I've gone through many courses and training, and I have the credentials as a business valuation expert. And accountants are good at reporting on the past. That's what they do, but they are not experts at valuing businesses. And I would question that accountant who's saying that they can value the business. What they might be able to do is tell you what the shareholder's equity is in the business. And as I mentioned before, that is not going to be the value of the business. That is very likely going to be understating the valuation of the business, because it's not taking into account the earnings attributes of the business. So I wouldn't, again, business valuation experts, I have credentials that I've earned through taking valuation courses. I keep up to date on the current CPA, as all valuation experts must do to keep our credentials. We specialize in business valuation, and accountants are not necessarily, if you're just the client's corporate, tax accountant, their specialty is not business valuation.
That's a different expertise.
Yes.
Okay. Another question. If someone has a profit sharing only interest in a closely held company, is that a saleable interest, and how do you value that?
I really would need to see that shareholder agreement to get more in detail. Can the question I have, I'm not sure I can answer this right now, is can they sell that, the rights to that profit? I would need to see more details as opposed to what they really own to be able to answer that question.
How about if it's only transferable back to the majority owner?
Really depends on then the jurisdiction and why we're valuing the business. Is this a shareholder dispute? Is this matrimonial matter? What jurisdiction are we valuing it in? What do the courts have to say regarding such a transaction? So without much more in-depth information regarding it, I'm hesitant to give a full answer. But if whoever asked that question wants to call me and give me more information, I'd love to talk to them about how I can help them on it. It's just I would need more information to answer that question.
Okay. Anything else we should know? I'm sure there's tons of things we should know.
There's tons of information, and again, I love to help people. My passion is to help people settle matters in as cost-effective and efficient a manner as possible, so that they can go on their life. I love valuing small, closely held businesses because to me it's sort of like I didn't become a stock analyst years ago, but I'm valuing small, closely held businesses, and I really enjoy that. I should mention that our firm, we also get involved many times in determining lost profits and damages. If that's the case, and if it's a divorce matter, we don't just value the businesses. We can help determine what the true income of the money spouse is in the matter, and that could also help people in helping determine what the proper support is. And again, I just love working with small businesses and helping people settle their matters and move on with their life.
Okay, another question. Can you give Carl the sites for the cases you mentioned so he can get them to NJAPM members on this call?
I will. That's the Balsamides and Lawson cases. I will email those out to Carl right after this.
Okay. So before we go, what's the most interesting company you ever valued?
Oh, there's so many. It's hard to say. I have valued companies from small grocery stores to companies that have put satellites up in space. And I'm really hard pressed right now to come up with one company that was the most interesting company. Actually, I'm thinking about it now. I was involved in valuing a part of a sports franchise because I love sports. Mm-hmm. So going back and reading the contracts that this team, and it's a very local team, was involved in, the contracts of the players that are no longer playing for a team, I actually thought that was sort of fun to just see how much money they were spending on players that are no longer playing for a team. I'm not sure if that really answered the question.
No,
that was a lot of fun as being a local sports fan and getting to value that company. I don't want to say the name of the company, but
all right. Okay. Well, thank you very much. This is really enjoyable. You did a great job. I hope everybody enjoyed it. And next month, we're going to have a webinar on someone whose divorce mediation is their day job. So I'll be sending out the dates on that pretty soon. So thank you again, Michael, and thanks for everyone for watching. Take care.
Thank you.